Today's episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And a good afternoon. Welcome into Market Talk here on this Wednesday. Thank you so much for joining us. First day of the month of June. I'm your host, Jesse Allen. Today's show brought to you by our friends at Growmark FS. And thanks for being here, being part of our day today. MarketTalkAg.com is our home on the web where you can find us. And we have a lot to talk about in the markets today. Another sharp move to the downside in corn and wheat. Beans held up, though, but plenty to discuss. Let's say good afternoon to our good friend Mike Zuzolo with Global Commodity Analytics. Mike, great to have you back on, sir, and I hope you had a great Memorial Day weekend.
I did until I started looking at the markets on Monday night. It hasn't really changed much in terms of direction, Jesse.
No, it has not. Just initially, your thoughts, 2 straight days of heavy selling here in corn and wheat, feeling the brunt of it again today. Man, not the way I thought we would come back from a holiday weekend and enter the month of June, Mike.
Yeah, 2 weeks ago, we were talking about my expectation for the trade to take prices higher into the Memorial Day holiday because of the Indian wheat export ban, and a strong belief and opinion based upon research and history that Russia would not participate in letting grain out the Black Sea unless it was Russian grain instead of Ukrainian grain, and unless sanctions were lifted in other areas. And when I saw this week that the European Union went ahead and cut off about 2/3 of their imports of energies from Russia, because they did seaborne imports, not anything from the pipeline, I felt more secure in that belief. And nothing has changed except the price action. And so whenever that's happened to me in the past, Jesse, it seems to me there's something bigger going on that has less to do with supply and demand. Not that it doesn't have something to do with supply and demand, but that it has less to do with supply and demand. It has more to do with money and investment and flows of capital in and out. And one of the things that I've picked up on here the last 2 weeks is we've noticed that livestock has picked up on more of the energy trade instead of the equities trade. The grains, however, have picked up more on the equities trade and have kind of divorced themselves from the crude oil run higher and also the natural gas run higher, especially on today's trade. And I think that's indicative of the commitment of traders. I think that's indicative of where the hedge funds are in the managed money funds, especially buying into the livestock and keeping their crude long positions in place, maybe selling out of their grain positions, but not the soybeans, because the soy oil still has an attachment to the crude. And I think that's, generally speaking, where I think we're at right now. I'd say 70% of the market price action since last Friday or 2 Fridays ago has probably been that. I think 30% is probably about the commodity index funds just cutting out positions and liquidating broad-based the commodities, thinking that peak inflation is in place now.
Very true. Let's break things down a little bit here. I want to start. You sent over a table looking at some of the May prices, the highs and the closes, and let's just look at this to give us a little perspective to where we're at here before we dive deeper into today's action. Walk us through this chart a little bit, Mike.
Yeah, and the key to this chart was this was as of the close on Tuesday, and so now we can add even more to that in terms of the hard red wheat and the soft red wheat, especially, whereas the cattle and the hogs and the feeders have gained along with the crude oil. So even though I did this chart yesterday afternoon, it really helps add to the idea of what we were just talking about. But the long and the short of this table shows you that this is one of the main reasons why I think the wheat is such a great indicator to the overall sense of the funds, both commodity index funds, dollar related funds, and hedge funds. China, zero lockdowns, fears of lost commodity demand. And I think the easing of supplies because of these last 2 crop reports on Mondays and Tuesday, obviously with the holiday this week, help add to that. That fits into some of the 30%, I think, of what we've seen here in the price action. But because the wheat has let us down again, it's my leader to the downside right now. Minneapolis wheat should be the leader to the upside, but it has failed to do that this week. So, but I would still say, based upon this table, Jesse, hard red wheat, soft red wheat, and Minneapolis wheat should be the ones that bottom first. The second thing I'll say about this is the soybeans following more the livestock and the crude oil market, as we talked about before. I think we're getting to price points now where the soybeans are going to have a very difficult time of being able to keep this rally going without the corn and wheat bottoming. And after today's close, we lost some trend line support on both wheat and corn monthly charts.
Well, let's talk a little bit on the wheat side first. That's been the heaviest hitter, and this is another chart I'll pull up on the video feed. This is SRW wheat chart. Walk us through this and a little bit more with what you're seeing just going on with wheat here as we enter the month of June, Mike.
Yeah, the undervalue and overvalue lines that I have on those, I just updated here at the end of May, 1st of June, and I raised those by about $1.60 from where I was back in November. And I've been waiting for more data coming out of Ukraine and Russia and more data coming out of our country as far as world carryover supplies, world demand, world stocks to use ratios. And so my overvalue level of around 960 in the soft red wheat is up against some of the highs of 2008 before we went sharply higher, and up against the highs from 2011. And that makes me feel good from a standpoint of world stocks to use and those other big highs that we had back 15 years ago. Or 10, 15 years ago. So I would say the 960 level, we're way over that. And the reason I wasn't pushing hedges too aggressively was because we were above that trend line support, that orange trend line. But see, Jesse, the problem is now we're taking that orange trend line out. And when you look at the last 4 or 5 months of trade, there's really a lot of air below this market. And you could go all the way back down to, theoretically, that 960 level if you just looked at the chart by itself and kind of excluded the fundamentals. So this is why in the corn market and the bean markets this week, I got some puts in place just on today's close because we weren't able to hold some key trend lines like this. Now, for the wheat, I'm not doing any hedging whatsoever unless clients want to. I'm just going to take my risk in the cash market at this point, even though there could be substantial downside. I feel like the corn and the wheat especially have stronger cash basis and a cash bias that's more firm because the investors aren't going to monkey with that too much.
Well, let's roll right into corn and talk about cash corn versus futures, another chart you have here. And we were talking a little bit before we went on air real briefly. I'm worried about going down and testing some of those 100-day moving averages that we haven't seen in months in corn. And I would be worried that if we do and we break through some of those, there might be some air underneath this corn market as well. What are your thoughts with that and just what we're seeing with this chart, Mike?
Yeah, there's no question. I agree with you. I think the 100-day moving average in the July futures, which is about 7-8 cents below the market, maybe 10 cents below the market, really critical number. I think the key with the corn is it's still a follower. Well, when is it going to stop being a follower and take its own fundamentals and lead? Well, when it gets its own fundamentals. But we have no drought fear at this point. The ethanol mindset is locked in. As far as, yes, good, but the high record gas prices probably trimming overall consumption of both unleaded and ethanol. So why buy into this bulge here? And then we have the issue of other countries' supplies. Are we going to get a supply shortfall out of Brazil or not? Is Paris going to have a big hit to the corn supplies in Europe because they have a drought still brewing? What about our country? We've got some real issues in some parts of the central corn belt and bean belt that no one's really talking about. Well, that's where it goes back to the futures versus the cash. And that's why I like this Gulf corn chart. In purple is the Gulf corn price. Yellow is the price at the CME. We've built up about $1.15 to $1.20 premium in the Gulf price, Jesse. I went all the way back to 2006, 2007. I can't find a time period on a monthly basis where we've had this wide of a distinction. So what you see in that purple line is it was starting to go higher, but the Chicago Mercantile Exchange was going sharply lower. And now we've pulled down the Gulf price, but we still are keeping this huge premium. This is a major reason why I want to buy puts during this time period, because I think this is a correction in the futures. I think it's investment flows, as we talked about. And if I'm right about that, then another 10, 15% down in the futures market, that's where I want to pull back the puts, take theoretical profit, hopefully. And if we can do that, then go back open on my risk management, on my hedges, and then deal with what I look like in the fields and see exactly what my bushels are to maybe get some hedges in place on a secondary rally.
Well, and you mentioned it's some of the issues that aren't being talked about across parts of the country with corn per se. And then also, I think about some of the strong cash basis levels for corn, for beans, et cetera, across the country. But some growers may be hesitant just because they don't know what they're going to produce for a crop. So it's almost kind of a balancing act right now with this market. So you're talking about getting some floors underneath and some puts really makes sense, at least to me anyway.
Yeah, and the one thing that I don't think the trade is really, maybe I'm splitting hairs too much, but we've gotten recent gasoline demand numbers and they're holding up very, very well for right now. And I don't think the grains can say that because of the export market. So there is some supply demand issues that we do have to contend with. But Jesse, when we came out this morning and a key Ukrainian private analyst came out and said that they're looking at a 19.5 million ton crop in wheat, and that compares to a 21.5 million ton, I think USDA gave us on the last WASDE report. That's 42% less than last year as far as what they're expecting. That didn't change the market mindset or sentiment at all. So that's why yes, there are some supply demand fundamentals that I think you can maybe hang your hat on as to why the market's not buying this market right now or buying the dip, but are they really liquidating and selling out because of the fundamentals? And I just don't see it. I think it's more the macro fundamentals of inflation, and you can get a lot better return on the bonds. And why not just stick with the energy since you're going into summer, especially the natural gas? And that's where the drought bowl, I think, really was needed during this time period as we transition from planting into growing this crop in the summer.
I should ask as well. I know Reuters released a story today about the Biden administration likely to raise ethanol blending volumes for 2021, sounding like they want to put it in line with U.S. consumption, which
Mhm.
recent federal figures has that number 13.94 billion gallons. So if that comes to fruition, what impact do you think that could have on the corn market, Mike?
Well, here again, I thought that was a pretty decent newswire story to be able to maybe halt the declines in the prices, because 2021 maybe is rear view window, but it still manages to shake out a little bit on the quarterly grain stocks reports what we may see in disappearance, and it may tighten our numbers up a little bit. But it's really about 2022, and in the Reuters story even went deeper into that on some subsequent updates that could lead us to believe that the ethanol demand and the mandate and the blending is going to remain very, very high in terms of the government mandate, and it's less uncertain that we'll lose demand because of the issues of pure consumption and record high gas prices. So again, between the wheat and the Ukraine and this news story, I thought, hey, there's a couple reasons why some short-term traders who want to cover their short positions. Didn't have any of that at all.
Let's talk about that pork and bean trade that I know you like to talk about. You alluded to this earlier, but soybeans, the soy complex today really held up well. And yeah, kind of watching that pork and bean trade back and forth. So walk us through this chart and what you saw with soybeans today, Mike.
Yeah, after April, this market tended to diverge itself. We had a really sharp rally. The purple line is the hogs. We had a really sharp rally in the hogs. They played catch up with the soybeans, and now they're starting to tick pretty closely with one another again since the second half of May. And I think this goes back to the Chinese lockdowns in Shanghai being lifted, and the Chinese looking at a better near-term summer demand. And it sounds like a lot of people want to unwind now in Shanghai and some of these other cities that are locked down. Wouldn't get too far ahead of this though, because we still got a really rough ride ahead in China. A lot of big banks and a lot of economists are cutting their growth this year to only 3 to 4% in real terms. That should set the stage for some massive unemployment. China bought some pork for reserves. Usually, when they do that, in my opinion, Jesse, they're trying to prop up the Chinese domestic pork price. So, don't want to get too far ahead of this, especially in the soybeans, because I think we still got a decent crop being grown in the soybeans at this stage of the game. And I don't think the consumption side of the Chinese pork mindset is going to bring us in these massive 99, 100 million metric ton imports for this new crop year at these price levels. If we were at $10 beans, sure, maybe we would, but not at $15, $17 beans. So that's why I was very eager to hedge beans in case we went below 15 and a quarter in November today.
Well, let's segue from beans into the hog trade today, Mike. Very strong in the front months. I know the deferreds were a little more mixed, but you look at front month hogs on the close today, June only up 182, but I mean July 442 higher today, August up 250. This front month hogs really had a good day today. Was some of that spillover though from cattle? What's your thoughts there?
I really do think so. I think the commitment to traders data, when I saw that late last week, early this week, and I saw that based upon my analysis, the funds are a record net short in feeder cattle after coming through that terrible supply of cattle on feed for placements and on feed numbers and pretty disappointing marketings to boot, and not having follow through selling. It kind of signaled to me that the funds had already built their position up. They were ready to cover shorts. And I think the funds are feeling better about summer grilling season and the demand side of this market than I am, quite honestly. So I think they're evening up positions. Will they go net long in the feeders? I think they probably will, because the cash feeder market's really starting to get active with this improvement in pasture. We've really cut the drought for cattle areas down substantially, and I think around 20+%. Before we go into the next weekly drought update tomorrow or Friday. So I think, yeah, the follow through spillover effect in the hogs, I think, was led by the fats and the feeders. And I think that's something that we'll probably see continue in this time period. But I think the hogs really found support off that soybean trade, because soybeans dipped, they came back, and it seemed like that just juiced up the hog market even more.
Well, and you mentioned cattle there, feeder cattle, huge day today, up well over $4 in pretty much all those contracts. Fats were up mostly triple digits as well. I know with the corn market breaking lower, that probably had to help some in cattle. But as you alluded to, a little more optimism from some folks for grilling season. We'll see what that looks like here as we work through the week and get into the month of June, but also cash trade. I know we're watching that, and a little bit of activity, but not a lot here so far this week.
No, and in fact, we saw Southern Plains dip $2 here in the midday update, and that puts you at 135. But you still have a premium in the cash versus the futures. I think the heart and soul of maybe this summer grilling season is the ground beef. It really got featured. It seems like it really moved over the weekend and did very, very good business. One chart I thought about putting up this week with you, Jesse, was the June cattle chart, because we've got a 40-day moving average as resistance just above the market at 134.20 area. If we take that out, you've got a lot of air above you, just speaking strictly from a chart perspective, because you've got a gap then above this market around 137 to 138.35. So that might be a target for some of these funds to go after if we can take that 40-day moving average out. So listeners and viewers maybe want to take a look at a June fat cattle chart, and that might be an area to set your sights on for some hedges if you got some really extra fat cattle that you've held back on marketings and you need to get current again.
I think we should mention the energy side as well here today, Mike. Crude oil's up and down. We spiked yesterday, pulled back down. We were up today. We're pulling back down a little bit here as we're talking right around the 115 mark. I know heating oil was up today. I just wondered with this energy complex, and there's a lot of talk surrounding it still with inflation. What are your thoughts here as we hear more and more whispers about gas prices and diesel continuing to rise, and just the impact of energies right now?
It's almost assuring us of a recession, and it's almost assuring us of a global recession. But I think, like the Russian-Ukrainian war, we're going to be at our 100-day mark on Friday for this invasion. Like the trade didn't get right, the inflation being transitory, like they didn't get right the issue of the Russians invading Ukraine because they thought it was part of Russia and the Soviet bloc. I don't think they're getting right the attachment of the food and the grains with the energies. I don't know how you can have weaker grain prices in 6 months if we take these kind of energy prices even higher, because it's going to take a lot of energy to make that next crop around the world. And the farmers and the governments of this world aren't set up for it, Jesse, in my opinion. So I think this is where, again, I'll reiterate, this market, I think, is in a corrective mindset. I don't think a top is necessarily in place, mainly because of the issue with the energy markets and what they're going to do to us.
Mike, great analysis as always. Any final thoughts for us on this Wednesday?
Got the free trial back up on the website, so sign up. This is the time to do it. globalcomresearch.com, and be happy to sign you up and talk to you once after the trial and see what you think.
globalcomresearch.com is where you can find all that info and the free trial. And as always, we appreciate the time. With that, Mike Zuzolo with Global Commodity Analytics, thanks for joining us here on this Wednesday.
Jesse, I appreciate you having me.
And that is going to do it for Market Talk here on this Wednesday, June 1st. Find us online, markettalkag.com. I'm your host, Jesse Allen, wishing you a great rest of your day.